The money in your bank account doesn't really exist. That's not a metaphor, and it's not a conspiracy talk. If every single customer walked into their bank tomorrow to withdraw their cash, the system would collapse within hours because the money simply isn't there. This isn't an accident or a glitch. It's the design of the global financial system, a trick so old, so entrenched, that we've come to accept it as normal. It's called fractional banking, and it is the quiet engine behind global debt, inflation, and the illusion of wealth. Once you see how it works, you'll realize that money itself is built on promises that can never truly be kept. To understand how this began, we have to go back to a time before our world ran on digits in an app. In medieval Europe, gold and silver were money, but carrying bags of gold was dangerous. So people began leaving their valuables with goldsmiths, who had secure vaults. In exchange, the goldsmith would issue a receipt, a note promising that the bearer could return and collect their gold. Soon, people realized they could trade these receipts instead of the actual gold. After all, the note represented the value just as well, and it was a lot lighter to carry. Here's where the trick was born. The goldsmiths noticed that almost nobody came to claim their gold at the same time. Most of it just sat untouched. So the goldsmiths got clever. They began issuing more receipts than the gold they actually had. They could lend those extra receipts at interest, profiting from gold that didn't exist. As long as everyone didn't demand their coins at once, no one noticed. It was, essentially, money conjured from thin air. This wasn't just a neat side hustle. It was revolutionary. The moment people accepted paper claims as good as gold, money creation became unshackled from physical reality. Banks emerged from this practice, and by the 17th century, governments themselves embraced it. The Bank of England was founded in 1694 to solve a problem. The crown was drowning in debt from endless wars. The bank lent money to the government, far more than it actually held in reserves, in exchange for interest payments. The debt was repaid not with treasure from new conquests, but with the taxes of ordinary Englishmen. Sound familiar? That is, because it is the same mechanism governments use today, borrowing money that doesn't exist, then taxing future generations to pay for it. Now, let's break this down in today's terms. Imagine you walk into a bank and deposit $100. You think that money is sitting safely in your account? In reality, the bank is only required to keep a tiny slice of it. In the past, that fraction might have been 10%, meaning the bank would keep 10 and lend out 90. Someone borrows that 90, and the shopkeeper they pay deposits it into another bank. That bank keeps 9 and loans out 8. This cycle repeats, and your original $100 has now multiplied into nearly $1,000 circulating in the economy. But here's the catch. Only the first 10 actually exist as cash. The rest is debt. If that shocked you, I have some bad news. In the United States today, reserve requirements are not 10%. They are zero. Since March 2020, the Federal Reserve has required banks to hold nothing against the deposits they take. So what stops them from lending infinity? The leash today is capital and liquidity rules, set under a global framework known as Basel. These rules are created by a group of central bankers who meet in Basel, Switzerland, at the central bank of central banks. They aren't written by Congress or Parliament, but by unelected technocrats. Basically, banks must have enough of their own money, or equity, to absorb potential losses. The more risky the loan, the more capital they must hold. But notice what changed. Banks don't lend from deposits anymore. They create loans first, which in turn create deposits. When you get a mortgage, the bank doesn't pull cash from a vault. It types new money into your account, created because you agreed to pay it back. That's why over 90% of the money in circulation is bank money, created out of thin air the moment loans are issued. This design has 3 unavoidable consequences. First, inflation. As banks multiply credit, the value of each dollar erodes. Second, perpetual debt. Since money enters existence as a loan with interest, there is always more debt in the system than there is money to repay it. Someone, somewhere, must always borrow more. Third, concentration of power. Banks collect interest on money they never had, while the wealthy, who owned hard assets, benefit from inflation as asset prices rise, leaving ordinary workers behind. When this machine hiccups, the illusion cracks. The Great Depression, the 2008 financial crisis both were caused by banks loaning wildly beyond reality. When panic hit, the money wasn't there. Each time, governments stepped in, pumping trillions into the system to keep the illusion alive. So here's the uncomfortable truth. The system cannot afford for you to be debt-free. If everyone paid off their loans, the money supply would collapse. The illusion depends on your participation. This means you must rethink your relationship with money. Saving cash won't protect you. Real wealth is not digits on a screen. It is land, skills, resources, and independence assets that hold value when paper promises dissolve. The lesson isn't paranoia, it's awareness. If your money is born as someone else's debt, then your freedom depends on stepping outside that machine. So the next time you look at your bank balance, remember, it's part of a game where the house always wins. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.